The market does not move because of excitement, news, or your opinion. It moves because of decisions that were made long before you noticed the move. Those decisions live on the higher time frames. They are not emotional, they are not impulsive, and they are not reactive. They are deliberate. When price moves strongly in one direction, it is not the result of a sudden idea. It is the result of accumulated agreement. That agreement cannot form on small charts. It requires time, size, and patience. That is why higher time frames always carry authority. Most traders spend their lives trying to control what cannot be controlled. They stare at small movements, trying to predict the next candle, believing that faster information equals better results. But speed does not create clarity. It creates distortion. The closer you stand to price, the louder the noise becomes. Every tick feels important. Every pause feels threatening. And in that environment, judgment collapses. Time frames remove this distortion by slowing reality down. They show what price is actually doing, not what it appears to be doing in the moment. Authority in the market flows from the top down. A lower time frame cannot overrule a higher one. It can only react within it. When traders ignore this, they trade against gravity. They may be right briefly, but they are wrong structurally, and structure always wins in the end. You can profit temporarily fighting the higher time frame, but you cannot build consistency that way. Eventually, size and time will overpower speed and hope. Higher time frames expose the truth about trends. A trend is not a series of fast candles. It is sustained acceptance at higher prices or lower prices over time. This acceptance is visible only when you step back far enough. When you do, fear begins to disappear. You no longer feel chased by price. You stop needing constant confirmation. You understand that if the higher time frame has not changed, nothing meaningful has changed. This understanding transforms risk. Stops become logical, not emotional. Position size becomes disciplined, not hopeful. Losses no longer feel like punishment, they feel like part of execution. You stop blaming the market because you are no longer surprised by it. Everything that happens on the lower time frame is seen as behavior, not direction. The trader who respects higher time frames gains patience without forcing it. Waiting becomes natural because there is nothing to chase. Opportunities are not hunted, they are recognized. You begin to trade less but with more confidence. You stop trying to be clever and start being aligned. In the end, the market does not reward intelligence or effort. It rewards obedience to structure. Higher time frames are that structure. Ignore them, and the market will correct you. Respect them, and the market will carry you. Higher time frames reveal something most. Traders never learn to see real commitment. Commitment is not found in fast candles or sharp spikes. It is found in the ability of price to remain accepted at certain levels over time. When price holds, builds, and continues in one direction on a higher time frame, it is not an accident. It is proof that large participants are comfortable, patient, and in no rush to exit. That comfort is power, and power always leaves a trace if you know where to look. Lower time frames can only show activity. Higher time frames show intention. Activity is cheap and temporary. Intention is expensive and slow. Anyone can buy or sell quickly, but only large money can sustain price over long periods. That sustainability cannot be faked. It requires volume, capital, and conviction. This is why higher time frames act as a filter between illusion and reality. They separate movement from meaning. Most traders confuse being busy with being effective. They enter trades because something is happening, not because something has already happened. They want to catch the beginning of a move instead of participating in a confirmed one. But beginnings are fragile. They fail often and fail fast. Higher time frame moves, once established, have weight behind them. They do not reverse easily. They do not need constant defense. They progress because they are supported by agreement, not hope. When you align with higher time frame commitment, patience stops being a struggle. You are no longer waiting for the market to owe something. It has already done it. Your job becomes simple execution within an existing condition. This removes the emotional pressure to act. You no longer feel late because you understand that meaningful moves take time to unfold. There is room to enter, room to manage risk, and room to be wrong without being destroyed. Higher time frames also expose false strength. A sharp rally on a small chart can look impressive, even convincing. But if it fails to hold on the higher time frame, it is nothing more than a reaction. Reactions exhaust themselves. Commitment endures. This distinction saves traders from countless losses caused by chasing temporary enthusiasm. Risk becomes clearer when commitment is visible. You know where you are wrong, not because price twitched against you, but because the higher time frame condition changed. Until then, fluctuations are noise. This clarity allows you to hold winning positions longer and exit losing ones earlier, not out of fear, but out of logic. The market does not reward those who guess intention. It rewards those who recognize it. Higher time frames make intention visible. They are the only place where the market speaks clearly enough to be trusted. When you learn to listen there, everything else becomes quieter, slower, and far more profitable. Lower time frames are where most traders lose, not because the market is cruel, but because emotion is amplified there. Every movement feels urgent when information is compressed. A single candle K. N look like a decision. A fast move can feel like a signal. But speed creates illusion. The lower the time frame, the louder the noise, and the stronger the emotional pull. Without higher time frame guidance, traders mistake reaction for direction and excitement for opportunity. On lower time frames, the mind is constantly stimulated. Price moves quickly, stops get hit fast, and outcomes feel personal. This environment encourages overtrading. The trader begins to believe that constant action equals control. In reality, it produces the opposite. The more decisions you make under pressure, the less disciplined each decision becomes. Emotion slips in quietly, disguised as intuition or urgency. Lower time frames also distort risk. Small movements look harmless, so position size increases. Stops feel tight, so confidence rises artificially. But when the higher time frame asserts itself, those small positions suddenly become oversized. Losses feel unfair because the trader never saw the larger context. What looked safe was never safe. It was just incomplete information. This is where most trading psychology breaks down. Traders blame execution, strategy, or bad luck, when the real issue is perspective. They are trading fragments of information and expecting complete outcomes. Lower time frames cannot provide that. They show behavior, not structure. They are useful only when they operate inside rules set by a higher authority. Without higher time frame alignment, every pullback feels like failure, and every breakout feels like opportunity. This emotional swing creates inconsistency. One trade is held too long out of hope. The next is cut too early out of fear. The trader is not reacting to the market. He is reacting to himself. The chart becomes a mirror of internal chaos. Higher time frames neutralize this effect by slowing perception. They reduce the number of signals while increasing the reliability of each one. When you know the dominant direction, lower time frame movements lose their power to intimidate you. A pullback becomes expected, not threatening. Consolidation becomes preparation, not boredom. Lower time frames were never meant to lead. They were meant to execute. When traders assign them leadership, they invite emotional instability into their process. The result is exhaustion, frustration, and a constant sense of being one step behind. When the higher time frame defines direction, the lower time frame regains its proper role. It becomes a tool, not a dictator. Emotion fades because decisions are already framed. You are no longer searching for meaning in every fluctuation. You are simply waiting for price to cooperate. The trader who understands this stops fighting himself. He stops chasing urgency. He stops trying to win every moment. Instead, he aligns his actions with structure, and consistency begins to replace chaos. Alignment is what turns trading from guessing into execution. Without alignment, every trade is a debate. With alignment, every trade is a decision. Higher time frames create this alignment by defining the condition of the market before you ever look for an entry. They do not tell you what will happen next. They tell you what is already in control. This distinction is critical because prediction creates pressure, while alignment creates clarity. Most traders spend their energy trying to forecast outcomes. They want to know where price will go so they can feel safe acting. But safety in trading does not come from certainty, it comes from structure. Higher time frames provide structure by establishing boundaries. They define where price has been accepted, where it has been rejected, and where it is likely to struggle. Inside those boundaries, lower time frame entries make sense. Outside them, even perfect entries fail. When alignment exists, trades no longer feel urgent. You are not racing the market. You are waiting for it to move into a zone that already matters. This waiting is not passive. It is intentional. It is the patience of someone who knows that opportunity does not disappear. It rotates. The market will always return to areas of interest because that is where unfinished business lives. Alignment also simplifies decision-making. You stop asking too many questions. You stop adjusting your bias with every candle. The higher time frame has already answered the most important question: who is in control? Once that is clear, your only responsibility is execution. This reduces emotional fatigue and preserves mental capital, which is far more important than being right on any single trade. Without alignment, discipline is impossible. Rules are broken because they feel optional. Fear and greed find space to operate. But when you are aligned, discipline becomes natural. You are not forcing yourself to follow rules. The structure makes alternatives unattractive. You know what does not belong, so you do not take it. Alignment also changes how you experience losses. A losing trade taken in alignment does not damage confidence. It is understood as variance, not failure. But a loss taken against alignment always hurts more, because deep down you know it was unnecessary. This difference shapes long-term behavior more than any reward. Over time, alignment builds consistency not through perfection, but through repetition. You repeat the same process in the same conditions. You trade less, but with more intent. You stop trying to outsmart the market and start working with it. This is why alignment matters more than prediction. Prediction tries to control the future. Alignment respects the present, and the market only ever rewards those who respect what already exists. Patience in trading is often misunderstood as hesitation or fear, but real patience is neither. It is a position of strength. It comes from understanding that the market does not respond to urgency. It responds to time and acceptance. Higher time frames cultivate this kind of patience naturally, because they remove the illusion something must be done right now. They show that meaningful moves take time to form and even more time to complete. Impatience is born on lower time frames. When price moves quickly, the mind assumes opportunity is escaping. This creates a need to act, even when conditions are incomplete. Higher time frames dissolve this pressure by showing how much space price actually has to move. What feels like a late entry on a 5-minute chart is often perfectly timed within a larger structure. When you see that, the urge to chase disappears. Patience also protects capital. Most losses come not from being wrong about direction, but from entering too early. Higher time frames reduce early entries by forcing confirmation. They demand that price prove itself before you commit. This proof is expensive for the market to produce, and that cost is what makes it reliable. Cheap signals fail easily. Expensive ones endure. When patience is rooted in structure, waiting becomes active preparation. You are not watching price aimlessly. You are waiting for it to reach levels where decisions matter. This transforms time from an enemy into an ally. The longer price moves within a higher time frame condition, the clearer that condition becomes. Higher time frames also prevent emotional revenge. After a loss, the impulse is to recover quickly. Lower time frames make this easy and dangerous. Higher time frames slow the process down enough to interrupt that impulse. They remind you that one trade means nothing. In the larger sequence. This perspective is what keeps traders solvent over time. Patience also improves confidence. Not the loud, fragile kind, but quiet confidence rooted in preparation. You know why you are in a trade, and you know what would invalidate it. There is no need to monitor every fluctuation. This detachment allows positions to work without interference. The market rewards patience because patience aligns you with how the market actually operates. Large participants do not rush. They accumulate, distribute, and manage positions over time. By aligning with higher time frames, you adopt the same rhythm. You stop trying to outpace the market and start moving with it. In the end, Patience is not about waiting for the perfect trade. It is about waiting for the right conditions. Higher time frames define those conditions, respect them, and patience becomes effortless. Ignore them, and impatience will keep extracting its price. Survival in trading has nothing to do with intelligence, and everything to do with respect. Respect for risk, respect for structure, and respect for the forces that actually move the market. Higher time frames represent those forces. They are the foundation on which every sustainable trading career is built. Traders who fail to respect them may experience moments of success, but they do not last. Longevity belongs only to those who accept control instead of trying to seize it. The market is larger than any opinion, strategy, or single trade. Hig. Our time frames remind you of this reality constantly. They show how small your position truly is within the larger flow. This humility is not weakness, it is protection. It prevents overconfidence, oversized positions, and emotional attachment to outcomes. Without this humility, traders eventually overextend, and the market corrects them harshly. Higher time frames also enforce discipline without effort. When your framework is built from the top down, many bad trades simply disappear. You are no longer tempted by setups that exist in isolation. If a trade does not belong within the higher time frame structure, it is ignored. This automatic filtering is what keeps risk contained over hundreds and thousands of trades. Consistency emerges not from avoiding losses, but from controlling their size and frequency. Higher time frames help with both. They reduce the number of trades by eliminating low-quality opportunities, and they improve risk placement by making invalidation levels clearer. Losses become part of a controlled process rather than random shocks. Survival also depends on psychological endurance. Constant decision-making drains mental capital. Lower time frames demand attention without offering clarity. Higher time frames reduce this burden. They allow you to step away, think clearly, and act only when conditions align. This preserves focus and prevents burnout, which quietly destroys more traders than bad strategies ever do. As time passes, traders who respect higher time frame develop a different relationship with the market. They are no longer reactive, they are prepared. They do not feel compelled to trade every day. They understand that absence from the market is also a position. This restraint is what keeps them present long enough to benefit from experience. The market does not care how hard you try. It responds only to how well you align. Higher time frames are the blueprint for that alignment. Ignore them, and survival becomes a matter of luck. Respect them, and survival becomes a byproduct of discipline. Over time, discipline compounds, and compounding is the only edge that never disappears. Survival is not a dramatic concept in trading, but it is the most important one. Many traders focus on profits, strategies, and entries, yet ignore the simple truth that the market only rewards those who stay long enough to learn its rhythm. Higher time frames are the silent guardians of survival because they force restraint. They slow you down when emotion wants speed, and they reduce exposure when ego wants expansion. This restraint is not limitation, it is protection. When traders ignore higher time frames, they slowly accumulate invisible damage. Overtrading drains focus. Frequent losses erode confidence. Random wins inflate ego. This imbalance grows quietly until one bad period exposes it. Higher time frames prevent this by enforcing selectivity. They remind you that not trading is often the correct decision. They teach you that missing a trade costs nothing, but forcing one can cost everything. Higher time frames also reshape how you view success. Success is no longer measured by daily wins, but by stability over time. You stop asking how much you can make today and start asking how much you can protect this month. This shift changes behavior. Position sizes become intentional. Risk becomes calculated. Trades are taken because they belong, not because you are bored or impatient. As you continue trading with higher time frame respect, emotional reactions weaken. You no longer feel excitement from random movement or fear from temporary pullbacks. The market becomes quieter because your mind is quieter. This emotional neutrality is rare, and it is powerful. It allows you to follow your plan even when outcomes are uncertain, which is the only environment trading ever offers. Higher time frames also create accountability. When you lose money trading against structure, There is no confusion about why. Responsibility replaces excuses. This honesty accelerates growth. You stop searching for new indicators and start refining behavior. Over time, this refinement compounds into consistency. Eventually, trading stops feeling like a battle. You are no longer trying to outthink the market or outpace it. You are simply positioning yourself where probability already exists. This is where survival turns into longevity. Longevity turns into mastery not through brilliance, but through repetition and restraint. The market does not demand perf. Qishan, it demands respect. Higher timeframes embody that demand. They ask you to slow down, see clearly, and accept your place within the larger structure. Traders who accept this survive long enough to benefit from experience. Those who resist keep restarting their journey. In the end, survival is the real edge. Higher timeframes protect that edge every day, quietly and consistently, for those disciplined enough to listen.